Hey, what's going on, guys? This is Kayvon Invests. My name is Kayvon, and this channel is about investing and trading. For this particular video, I want to focus on capital gains tax. In 2020, we had a lot of new investors coming into the market for the first time. Retail investing is at an all-time high, so if you're new to investing and you're thinking about taxes with tax season being right around the corner, this video will serve you well, as I'll be giving you a couple tips and advice that I've gained over my several years of experience in the stock market. Now, to start off, what is a capital gains tax? So the easiest way to think about this is, let's say I made an investment for $100 a share, and I have held that share for about 3 months, and that stock is now up to $120 a share. So your initial investment was $100 for one share. Now, 3 months later, that one share is $120. You have gained $20 on that investment. So that's a capital gain if you decide to sell that stock. Now, at the end of the year, you're going to have to report that to the IRS and say, okay, I've made $20 on this investment. And because it's a short term investment, you have to pay a certain tax percentage on that. Now, a short term investment is any investment that has been held for under a year. A long term investment is any investment that's been held for more than a year. If you're somebody that makes multiple purchases and sells multiple shares, let's say you're a day trader or swing trader, and let's say you have 100 different purchases for the year 2020, and you've sold like 100 stocks in the year 2020, you want to take all that information. You'll get a form from your brokerage. Let's say it's Robinhood or TD Ameritrade. Those are two very big popular brokerages. They'll send you a form called the 1099, and you'll be able to review all that information on that form. It'll show you all of your investments, and you can essentially calculate your net gain or net loss for that year. So 3 key takeaways that you want to make sure you understand. A capital gain occurs when you sell an asset for more than what you paid for it. If you hold an investment for more than a year before selling, your profit is typically considered a long-term gain and is taxed at a lower rate. So this rate is generally about 15%. Again, depending on your income and other factors, this might vary. Another key takeaway is that you can minimize or avoid capital gains taxes by investing for the long term, using tax advantage retirement plans, and offset capital gains with capital losses. So if you have been investing for multiple years, and let's say you have some net losses for 2019, you can actually carry that over to 2020 if you have a net gain for 2020. So that'll actually help you gain even more money. So again, this is why it's important to make sure that you're seeking a financial advisor or accountant to optimize your returns. But it's something that you want to think about. There are two types of investments. There are short-term investments and long-term investments. So for tax purposes, if you've held a stock for under a year, it is considered a short-term investment. And you decide to close that position and cash out on it, that's a short-term investment. However, if you've held it or have held it for longer than a year and then you close your position, then the tax penalty will be much smaller than if it was a short-term investment. Here's an example of how a capital gain will affect your earnings. If you bought 100 shares at $20, that would cost you $2,000. Let's say you sold 100 shares at $50. That's a $30 difference. It's $30 more than you originally purchased it for. You now have $5,000. Okay, so that's a $3,000 difference. Your capital gain is $3,000. Let's say it's a long-term investment and you did hold it for more than a year, then you'll be taxed at 15%, which would cost you $450. This is your profit after tax. It wouldn't be $3,000, it would be $2,550. So that's adjusted by the $450 that you paid, the 15% you paid on $3,000. Here's 3 levels of long-term capital gains tax for 2021 that you want to consider. It can be as low as 0%, 15%, or 20%. If you're single and your income is up to $40,400, you're not paying any taxes on capital gains. If the head of household is up to 54,100, 0%. Okay, so you can take a look at this chart and see which one applies to you. You'll be taxed at 15% if you make $1 over this amount, and that's up to 445,000, or you can pay up to 20% if your income happens to be over $445,850. Some great ways to minimize or avoid capital gains tax is to invest for the long term. So this is a strategy that I like to implement and I always encourage. I believe that the way to build true, genuine wealth is to do sound long-term investments and not focus so much on day trading or swing trading and trying to time the market. Very rarely does that ever work to your advantage. So to make things simpler, just invest in companies that you believe in, invest in companies that you trust and that you believe will be successful in the long term. Another great way to minimize or avoid capital gains tax is to take advantage of tax deferred retirement plans. So this could be a 401k, 403b, or an IRA. Again, I would seek a financial advisor or accountant to give you more information on those types of retirement plans. You can use capital losses to offset gains. So if you happen to have a net loss for 2019 and you're filing for 2020, you can actually transfer some of those losses from 2019 to 2020 to help you gain even more money or pay less taxes on your capital gains for 2020. Another great strategy is to watch your holding periods. If you're selling a security that you bought over a year ago, be sure to find the trade date of the purchase. Waiting a few days or weeks in order to qualify for long-term capital gains treatment might be a wise move as long as the price of the investment is holding relatively steady. This really applies more to, if you have an investment that you've held for, let's say, 11 months, so you're 4 weeks away from that investment to qualify as a long-term purchase or long-term investment. Is it wise for you to close that position after you've held it for 11 months? Or would you benefit more from waiting that extra 4 weeks and possibly paying, 0% on your capital gains or 15% or 20%, depending on where you fall in that category? So that's something you want to think about. This applies more for a stock that's really steady, a company that is not very volatile, and you have no reason to believe that it could go down or there's any potential catalysts, that could swing the price of the stock. So that's something you really want to consider and plan wisely. And lastly, picking your cost basis. So when you've acquired shares in the same company or mutual fund at different times at different prices, you'll need to determine your cost basis for the shares you sell. So I could be buying a share of a company for $20 a share, and then 2 weeks later I decide to buy another share, and let's say it's $23. Fast forward another 2 months and I buy 5 shares. Now, you have different buy-in times, different buy-in rates. So you want to take that into consideration. Generally, investors do use the FIFO or FIFO method, which is first in, first out. But some other ways to do so is the last in, first out, dollar value, average cost, specific share identification. So what I would advise is to talk to a tax advisor to help you determine your cost basis and figure out what's the best way to move forward. So there's a little overview of capital gains and how they work. The biggest thing to keep in mind is that yes, you do have to pay taxes on your capital gains, so make sure you're doing that accurately and ethically every year to make sure you're not avoiding any potential tax penalties or possibly facing jail time. But you want to make sure you're on top of all of this every year and keep that information into consideration next time you invest into a stock. Think about, am I holding this short term? Am I holding this long term? And how will these tax implications affect me and my investments moving forward? So I hope you guys learned something today. If you liked the content, please subscribe. Hit hit that thumbs up, hit that notification bell. Thanks for watching, and we'll see you next time.